My name is Alistair Ross. I'm from the Economist Intelligence Unit, where I, among many other things, am in charge of one of our main risk products, which deals with operating risk for companies all over the world. I'm very pleased to welcome you to this afternoon's session. We have a big lineup, but a very, very diverse and very interesting lineup, I think you'll agree, and I'm sure it's going to be a very stimulating session. A brief apology from me. A couple of days ago, I was speaking to about 150 marketeers in London, and I was the only person in the room with a tie. Today, I've come without a tie, and I think I'm one of the very few people without one. So I apologize for my awful dress sense. Well done. Well done. So the subject for this afternoon is risk, specifically disaster risk. But I think the key theme for me that's interesting here is that, you know, we're all extremely familiar with the human cost of natural disasters in far-flung corners of the world, distant and close to home. But increasingly, as the world of business globalizes, and companies search further and further afield for newly developing markets and for ever more scarce resources, this is becoming a real business issue. It's sad in a way, I suppose, to say that that interest in this area shifts as the economic costs rise, but that is the case, and I think it will be one of the themes that we'll be discussing. So we're going to start off with Andrew Maskery, who's the chief of the risk knowledge section, but also the coordinator of this global assessment report on disaster risk reduction, who's going to speak and give us a presentation for about 30 minutes or so. But then we'll move on and we'll have very brief presentations from the rest of the panel, who are all involved contributors to this endeavor in one form or another. And then I hope there'll be time after that for some Q&A with you. So please, as we go through the presentations, prepare your questions. Without further ado, may I hand on to Andrew.
Thank you very much, Alistair. Can everyone hear me? Because I can't pull the microphone any closer to me. But first of all, I'd like to thank Alistair for chairing the session, and also all our panelists, because the Global Assessment Report is not just a UN report or a UN ISDR report. It's really a collective endeavor from, dozens and dozens and dozens of institutions and even more individuals all around the world who contribute research, data, thinking, and ideas to this process. So some of you are on the panel, and a lot more of you are just in the room. So I would just like to start this all by really a set of really thanks to everyone who's been working with us and supporting this effort over the last 2 years. But anyway, this report is different to our previous 2 global assessment reports in 2009 and 2011. The 2009 one really focused on the relationship between disaster risk and poverty, so had a much more focus on the social sector, informal settlements, impacts on low-income households. The 2011 report addressed really how to get disaster risk factored into public investment and public investment planning. It was about governments building schools that don't fall down, transport infrastructure that stays up in floods, so on and so forth. But when we finished the 2011 report, we had a little reflection and we said, well, public investment is really key, it's really critical, but it actually is rarely more than about 15% of total investment in most countries. Let me try this one. Does it work better? Why don't I swap seats with Paul? Then I'm not so far away from the microphone. Thanks. So
don't know what he's going to say.
Paul of the Blended Capital Group has just moved over.
It says whiskey on the left.
Yeah. So we felt then that, well, what's happening with the other, 80, 85% of total investment? Where is that going? is risk being taken into account in company boardrooms when they're actually making investment decisions. So that's when we decided that the 2013 report, we would really focus it on the business sector, on the private sector, and see what was really happening. And it's been a very exciting, as I said, exploration involving, risk modeling, looking at how risk is being managed in different industry sectors, a lot of interaction with companies, surveys, case studies, and so on and so forth, which have all fed into this. Aha. Does anyone know anything about technology in the room? What am I doing wrong? It doesn't work.
Take your tie off. That'll probably work.
It's gone.
It's gone. Okay, we've now slipped over about 500 slides. But
It was snoozing.
okay. Anyway, the starting point of this is really a global issue, which is that disaster losses, if we look around the world, are a lot greater than we probably previously thought and are obviously going up. We have good estimations of losses, of insured losses from the insurance industry. We have good estimations of the costs of large disasters from global databases. But what we've done in this report, as in the previous GARs, we now access an increasing amount of national disaster data from different countries, which picks up on the losses caused by the smaller scale, floods, landslides, fires, and storms. And when you add those smaller scale losses to the larger losses, we really rapidly came to the conclusion that the internationally published figures that we should be around 50% higher. So the total losses we are losing are great and growing, and that's really the starting point for our explanation. These have, a range of different impacts on businesses. We probably best understand the direct losses, so that's when your factory gets flooded or your stock gets lost. But there's almost as that graph actually highlights, that's really just almost sort of the tip of the iceberg, because businesses suffer much bigger losses through the indirect losses. So this is, production shortfalls due to business interruption when your factory is not producing. And businesses also suffer wider effects, which may be, a loss of reputation, loss of market share, skilled workers leaving, relationships with partners and suppliers being severed. And interestingly, most businesses insure against direct losses, and some will take extended insurance cover so they can even insure against the indirect losses, but you can't insure against loss of reputation. And we start this report, the first few pages, we actually revisit the case of the port of Kobe, which was, almost destroyed by the 1995 earthquake in Kobe, Japan. And despite, major efforts both to rebuild the port as well as to make it more competitive, it went into a one-way decline and lost most of its market share. So it actually fell from being the 6th most important port in the world to the 47th in a space of only a few years. So it gives you this idea that when you actually lose business, it may never come back again. We also, in this report, we coined a term for the title, which is actually shared risks, because the risks don't really stop at the factory gate. Business risks pose risks for the wider community. They become shared with the wider community, society, and particularly in cases like small island developing states, with the whole economy. So businesses, when they make investments in a way which create risks for themselves, create risks for the wider economy, but that's also a two-way street, because businesses, depend on well-functioning, resilient infrastructure. So again, if the government is making investments, public investments, in a way that doesn't provide resilient infrastructure, they're actually sharing those risks with the business community. So the report, I think, really highlights the sort of interdependence, the mutual dependence between the public and the private sector in this area. The large disasters that happened in 2011 and 2012, such as the Thailand floods, the East Japan earthquake, the Christchurch earthquakes in New Zealand, Superstorm Sandy, more recently, I think we're a real wake-up call for global business. I think they started to realize that, that maybe they had actually billions of dollars of assets at risk, which maybe were looking like nice assets on their balance sheets, but maybe were actually really contingent liabilities. But we often still tend to blame those disasters actually on the extreme events that caused them. So, exceptional floods and rains, or an earthquake and tsunami that was beyond anything that the scientists had expected in Japan. But really, I mean, all those factories that got flooded in Thailand, they didn't grow out of the ground and they didn't fall out of heaven. I mean, someone actually, as I said, made conscious investments decisions to making those. So to really understand why risk has been going up, why losses have been going up, particularly in emerging economies and emerging markets, we really need to understand the process of globalization over the last 10, 20, 30 years. Companies have been investing in areas for very good reasons, access to markets, good infrastructure, cheap labor costs, etc. But what they haven't been doing is really factoring in the disaster risk in those locations. So obviously, a lot of the investment goes into coastal areas. If you're into import and export, you need to be near ports or in river basins for the same reasons. So there's been so much investment in extremely hazard-prone areas. That means that the exposure to those hazards has rocketed up, particularly in Asia, but also in parts of Latin America, the Caribbean, and we will see a lot more of that in Africa in the future. So increasing exposure means increasing risk. That's why we've seen risk going up. So it's not about just extreme events. It's actually about investment decisions in company boardrooms. Large businesses, the large global corporations, may be able to buffer some of those risks. If I own 1,500 hotels around the world in 100 different countries, if at any one year 5 of my hotels get damaged in a disaster, I'm sure it's not going to really dent either the bottom line or the top line of a company. But most global companies rely on hundreds, if not thousands, of small and medium enterprises in their supply chains. And for the small enterprise, often disasters can be a matter of life and death. We did a survey, and this was coordinated for us by Florida International University of, I think, 1,300 businesses in 6 disaster-prone cities in the Americas. And that highlighted that, the key disaster-related disruptions they faced were all due to public infrastructure, power outages, water outages, telecommunications failures, transport systems breaking down. And what we've discovered when we compared this to our disaster data, that over 90% of interruptions to power, water, telecommunications, and transport are actually, again, not caused by the catastrophic, extreme, eventual events, but by the everyday small disasters. So for the small enterprise sector, there's a very close link to what we call extensive risk, the regularly occurring, recurrent disaster events. And a lot of the case studies we've looked at in the report show that, unfortunately, for the small enterprises, sometimes up to half never actually get back onto their feet, never actually reopen after a disaster. So it's a different problem, related problem, but different problem to the large enterprise sector. Businesses, when they make investments, also need to think about if the country they're investing in would actually be able to recover after a large disaster. Because you as a business can't recover if the infrastructure you depend on isn't rebuilt and doesn't recover quickly as well. So building on our global risk modeling work, we've also been looking a little bit at the resilience of countries, how if their economy is able to recover quickly after a disaster. What you're seeing in this graph is the case of Honduras. And countries they have a set of different things they can do to actually finance recovery, from raising taxes, issuing bonds, international assistance, national and international credit, etc. But once you've exhausted those options, some countries do face financing gaps. And what this graph is telling us is that in the case of Honduras, for any event over costing more than about $2 billion in direct losses, which is equivalent to 1 in 33-year event, but would actually be a financing gap. The government wouldn't be able to finance the recovery. So a business that is investing in emerging markets, I think this is, again, one of the things they need to be thinking about. We've looked in the report at a number of different sectors. We've looked at the urban development sector, we've looked at the tourism sector and the agribusiness sectors in particular. These maps of Delhi show, the sheer rhythm and expansion of urbanization in places like India, and it's now really gaining momentum in sub-Saharan Africa as well. This implies that trillions of dollars of new investment are going to flow into urban development in the next few decades. So whether that investment is actually made in a risk-sensitive way is going to have a huge impact on future risk levels. Are we going to build more garment factories like the one that fell down in Bangladesh a few weeks ago? Are we going to really build resilient cities? What we found when we've investigated this in the report with our partners who've worked on us with this area is there are still very weak incentives for risk-sensitive urban development. A lot of the development's speculative, which means that the gains are very short-term. And once the developer's actually sold on whatever is developed, be it an office block or a housing development, he actually sells on the risk. So unless he's unlucky enough to have a disaster when they're actually building, the risk is then passed on to whoever then purchases the property. And in terms of government regulation, it's, the general rule is ineffective. And we've included in the report, case studies from countries like, rich countries like the UK, showing that, there always seems to be loopholes in regulating urban development, be it through zoning or land use plans or building regulations, which the developers seem to be able to leap through. So only weak incentives currently for factoring risk into urban development, but a key area if we're going to reduce risks in the future. We've also looked at the tourism sector, and I'm sure we'll be hearing more about that later from Susan. Again, a very tricky sector for the global economy. A lot of the small island developing states in particular have very high percentages of their total annual investment at risk from disasters. You can see from this graph, those of you can read it at the back, countries where one can expect, 40, 60, 80% of total annual investment from a catastrophic hurricane or cyclone. But because their economies also depend 40, 60, or 80% on the tourist sector, again, this is a case where, a disaster for the tourism sector then can become actually a disaster for the whole economy. But it's extremely difficult, I think, for the countries individually to get to grips with this problem. If I'm a small island and I say no to a new beachfront tourist development, the likelihood is that the developer will get the go-ahead from a neighboring island. So one of the things we say in the report here is that this really requires a regional approach between the SIDS. And also, an approach which recognizes that precisely because the risk is so high, anything one does in a small island to actually reduce the risk will really gain traction in terms of increasing the competitiveness and the resilience of these economies. The third sector we looked at was agribusiness and food security. So you're seeing a map here produced by Wadid Arian, who's joining us in the front row. Vast areas of Africa, the Middle East, and the Mediterranean are at risk, high risk, both from land degradation and from drought, agricultural drought. The two things are very, very closely related. And it's one of the risks which globally is, let's say, most weakly modeled. We're really only just starting to really understand now the dimension of it. But because of high global food prices, some of these countries are being really magnets for huge investments from the agribusiness sector. We know for a fact, I think in Ethiopia alone, something like 2 million hectares in the last few years has been subject to land acquisition, either by leasing or purchasing. So we have also a risk here of actually major investments flowing into areas where the risks are only weakly modeled. And obviously the risk of that then working through commodity markets and producing food price spikes. And this has an impact on food security. The work we've done with Save the Children, and you'll be hearing from Johara on this later as well, indicates really that food security is now increasingly more to do with what you can buy than what you can grow, even amongst, poor rural households in Africa. So these kind of major investment decisions also risk food price spikes, which again risk really the food security of both urban and rural low-income households, the kind of households who are typically spending a very large percentage of their total income on food. We then looked at really, well, if that's the situation in these sectors, I mean, what are really the incentives to get risk-sensitive investment? I mean, how can we get disaster risk being discussed in company boardrooms and when they're making plans and making investment decisions? We worked on this in the large corporate sector with PwC, and Oz will be, again, joining us a little bit later on the panel. And what we found is, most companies are increasing their investment in sort of enterprise risk management. But those strategies don't always include disaster risk. They're looking at other kinds of risk. Bringing disaster risk into the broader enterprise risk world is quite a recent thing. I think with PwC, there were workshops with around 14 large, brand name global corporations. And one of the things we found was that it's only really in the last 3 or 4 years that those businesses are really starting to take disaster risk into account. But at least there's a momentum there which we can build on. We also then looked at financing and investment, because obviously making an investment requires having the financing to make the investment. And here we worked with, amongst others, Paul from the Blended Capital Group. And again, we found, relatively still weak incentives for either investors or regulators to actually take disaster risk into account. And a large and growing gap between people like me. I mean, I have my money in the UN pension fund. Do I know where it's being invested? Is it being invested in companies which have got, vast amounts of their assets at risk from disasters? I haven't got the faintest idea. And when you're buying shares in that company, have the regulators made the company disclose all their disaster risks? Not necessarily. So, there's often sort of risk-blind investing going on, but also some interesting momentum in the area, which I'm sure Paul will refer to in his words. Insurance, should be one of our key, let's say, a key part of our armory in this. It really should be a major incentive for risk-sensitive investment, and this we've worked on with the Geneva Association, Walters at my right. In a perfect world with perfect markets, the price of insurance should reflect the price of risk, and if it did, it would actually act as a strong incentive for companies to decide where they're going to invest. But markets aren't perfect, and with the Geneva Association, we've, identified, some good opportunities, but also many challenges and hurdles for getting the price of premiums to actually reflect the price of risk. And particularly, again, in some of the emerging markets where insurance penetration is still very low, our understanding and modeling of the risks is still very incipient, which obviously poses risk-to-risk pricing. And there are other issues related to government intervention, subsidies, and so on and so forth, which again make the instrument, effective in terms of resilience, but not necessarily as effective in encouraging risk-sensitive investment. Governments should be playing a major role in this. We've now just completed our 3rd round of monitoring progress against the Hyogo Framework of Action. Around 130 countries have self-assessed their progress. Every 2 years, countries tell us that they're doing better and better, which is wonderful. But every 2 years, the losses go up, which is not so wonderful. So there's a kind of a missing link here between achieving the HFA and reducing the risks and the losses, which we need to think about. And it's perhaps because we're not actually necessarily talking to and engaging with the right parts of government, because while there's some parts of government who may be passing legislation and regulations and trying to address risks, probably the parts of government which have the most political and economic support, trade ministries, investment boards, and so on and so forth, are basically touring the world trying to bring investment into the country, and they may be offering, tax breaks, subsidized infrastructure, and other benefits to bring the investment in, which all economies need. But unfortunately, bringing that investment in, a lot of it is flowing into the hazard-prone areas we mentioned earlier. So, the incentives from the government side, again, are not necessarily as strong as they may seem in terms of encouraging risk-sensitive investment. But as I've been saying in bits and pieces as we've gone through this, we do see very encouraging signs of change and a lot of momentum in different areas. And this is where we really think we need to start moving from a situation where, because of a lack of incentives, we're generating shared risks, to a situation where we can actually generate shared values. One of these areas, and again, it's a question of, I think, just momentum, is getting the D word into corporate risk management strategies. So businesses, when they do make investments, take disaster risk into account, along with all the other risks they're going to look at. And this is, I think, very important to stress in the report. What the report isn't saying is don't invest in floodplains or coastlines or things like that. Companies are still going to invest in Hong Kong, Miami, and all sorts of other disaster-prone places. It's the way the economy works. But we're saying, well, before you do so, just take this risk into account. Don't ignore it. Don't invest blind. Invest really with your eyes wide open. If businesses do that, our impression is that that might be a very powerful incentive for governments to also change their behavior. And instead of sweeping risk under the carpet, actually say, well, instead of pretending, we don't actually have any risk. Because you often look at the brochures you get from countries to say, come and invest here. And even in highly disaster-prone countries, apparently the risk doesn't exist. So if businesses start to become more risk-sensitive when choosing where to make their investments, that also may produce a change on the government side in terms of actually saying, well, yes, we do actually have all these risks, but you can come and invest here because we're actually managing them and we have them under control. To do that, and also have, I think, the kind of, a word I used last week is, instead of a dialogue, a trialogue between governments, businesses, and the insurance sector, we need, let's say, a common song sheet. We actually need a common set of understood estimations of risk which we can have a conversation around. And that currently doesn't exist very easily. But we're seeing, again, I think, an interesting momentum of greater and greater collaboration between the private sector world of catastrophe risk modelers and our own world of, let's say, public sector science and international organizations, and a growing availability of open source, open access risk information built to the same standards. Omar Dario Cardona at the end, who's worked on our modeling effort, I'm sure will speak to that. And that kind of information, I think now, again, increasingly now has the potential where we could actually start having a proper dialogue about not only what the risk levels are, but actually who owns the risk. We seem to have a lot of stakeholders with not actually very clear about what stakes they're actually holding. So understanding actually who owns the risk, who's going to bear the risk, who's going to share the risk is key as well. On the financing side, and again, I'm sure Paul will talk to this, we're seeing, again, momentum, particularly in terms of the climate risk area, both of investors being much more, asking more challenging questions in terms of what they're investing in, but also regulators, being much stricter with companies, asking them to disclose their full range of risks. So I think moving from climate risk to the whole range of disaster risks is only a short hop. And again, if businesses feel, well, maybe we get a credit downgrade if we haven't, if we are disclosing our disaster risk and we have a lot of it, will be a powerful incentive for changing behavior. But last but not least, we've really tried in the report also to highlight that this is a huge business opportunity. I mean, if we are talking about trillions of dollars of investment flowing into these and other sectors, if we start making the case and businesses start really feeling that actually, disaster resilient buildings, infrastructure, agribusiness, tourism, or whatever, actually attracts, higher prices and creates better returns than stuff that falls down, that's going to be the big incentive. That's going to be really the big game changer, because then we don't actually have to make the business case for disaster risk management anymore, because disaster risk management will be business. So on that one, I would like to end. Thank you for your patience with my presentation, and invite you to explore the GAR in all its different forms. We've got a printed report of 200 pages for people who have insomnia. We have a pocket GAR for people who have a little less insomnia. It's the kind of thing you could read on an hour's train journey or plane. We have a GAR at a glance, which you can pin on your wall, your kitchen wall or your lounge wall, or depending on what you do in the evening, in your bedroom wall. And we've got a website which has got all the information interactively. You can explore it, download it, do what you want. And thanks to our collaboration with the Earth Literacy Program, and we'll be hearing from Professor Takimura at the end, we have a downloadable smartphone and tablet version, which is also very interactive and easy to use. So hopefully and we also have obviously products in Arabic, in Spanish and French, as well as English for all the products. And the Pocket GAR is translated into many other languages as well, Japanese, Chinese, Vietnamese, and so on. So hopefully we should have something for everyone. Thank you very much.
Thank you, Andrew. So no excuse for falling asleep over the next 4 or 5 days, it sounds like to me. So I'd like to move on now and introduce some of the people and the institutions who've contributed to this vast piece of work to take us through in a little more detail some of the relevant points that emerge from it. So we'll start with Paul Clement Hunt from the Blended Capital Group.
Alistair, thank you very much. I believe our time is limited, so this is going to be slightly Formula One. And let me start with a series of questions. Is our financial system stable? No. 30% of pension assets were lost in 1 week in October 2008. Are our natural systems stable? No. 200 financial institutions in 2012 said we'll hit $150 billion of losses a year by 2012. Sorry, in 2002, they said in 2012. That figure was passed in 2005. How are our emergent risks managed between these two systems, between our financial system, our investment system, which is completely geared, genuinely, to short-term incentives? That's where the incentives are aligned. So how are the risks between the financial system and our systemic risks in terms of natural issues and natural disasters, how are they managed? My contention is we don't manage them. They are not managed. Another question, how do long-term investors, what do I mean? Pension funds. Who's got a pension fund in the room? Put your hand up right now. Everyone, come on. Okay. So how do our pension funds, how do the sovereign wealth funds, those great pools of capital, how do our insurance reserves, how do they think about these risks? How do they manage them? How do the world's vast savings pools, what do I mean by that? Teachers, policemen, nurses, firemen, that's where the savings of the world are most concentrated. How do they think about the risks? To a large extent, the large pension funds and institutional investors do not think about risk in a structured, systematic way, and certainly not in a way that incorporates disaster risk. Look, global financial assets, what we've got in our banks, your deposits, in bond markets, in equity markets, at the end of 2012, that was $212 trillion, up by a factor of 20 since the early 90s. So that's not the value of the earth. I think it's valued slightly higher. But in terms of financial assets, that's what's at risk. More than 70% of global equities, the thing everybody thinks about when they think about the New York Stock Exchange or the Tokyo Stock Exchange, more than 70% of those assets are now traded on a high-frequency basis. We're not talking minutes, we're talking microseconds. So our system is aligned to the short term, and that does not align well with thinking about long-term or disaster risk. And I would also say that our long-term institutional investors are very much trapped in this system. They have to have short-term returns. So those who are managing assets for 30, 40, 50 years think short-term. Disaster risk is not really part of the picture yet. I think it's coming. I agree with Andrew. It's getting there, and there's a sensitization. Alistair, I'm very aware of time, so you'll give me, I'm sure, a heads up. So here's my contention from the work with UNISDR for GAR 2013. Question again, do these systems, the financial system and our natural systems, do they feed off each other to create, compound, and concentrate risk? And are natural disasters really disasters, or are they triggers which cascade risks through the system? Fukushima, we all know, the Thai floods, Beijing, it goes on and on and on. Many of these events are also at points of concentrated economic and urban infrastructure value. We are in a globalized system where risk travels quickly along supply chains. I won't state any of the examples, they are numerous. Is there a credible, structured communication between different facets of the policy world, between the finance ministry, between the development ministry, between the environment ministry, between the board of investment, between the market regulator? No, there is not a conversation that goes on in a structured way. At the very highest level, heads of government, G20, 2010, we want a stable, vibrant, resilient economic system that also factors in social and environmental goals. That's the G20 statement, 2010. But do their ministries speak to each other? No. Ad hoc basis, intermittent conversations. I would also say that the financial crash of 2008 killed those conversations dead. The first time finance ministers got together to speak on climate change was at the Bali COP, 40 finance ministers, for the first time talking about climate change. I think it was 2007 or 2008, just after the Stern report. Post the crash, the financial crash, those conversations just pretty well stopped, okay? So again, it's about policy cohesiveness. Let me sort of bring it to a conclusion. It's not all bad news, I don't think. I suppose the key, are those conversations happening in a policy sense? No. Do they translate into the investment world? Absolutely not. The mainstream investment community is short-term, 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 short-term. It just is. That's the way capitalism was grown up, and I'm a card-carrying capitalist, okay? So how do we change it? How do we align incentives more effectively? The disaster agenda and awareness about how a disaster impacts economic value and long-term savings is critical. I think it's absolutely fundamental. To finish off with a couple of things. The Thai example, the Thai floods, I was privileged to live in Thailand from 91 to 98, boom period before the bust. Everybody wanted to invest. It was one of the 18 darling developing countries, and people still do because there's so much that is right and correct. But where's the fiduciary duty in government to say, hey, whether you're a foreign direct investor or a portfolio investor, we have risks in country. Are you thinking about these risks? There is no incentive. That's not how you develop your career in government or business, by saying, don't come invest here until you think about the risks. I'm not picking on Thailand. It's a mismatch in communication within government. So let's finish with a couple of stats, I'm afraid. So over the next 20, 25 years, it's estimated there'll be 200 trillion, that's $200 trillion spent on urban assets by 2030, of which 40% will be in Asia, of which a big chunk will be in China. For every $100 million spent on urban assets and infrastructure, there's just $300,000 earmarked for looking at resilience of infrastructure, assets that have to last decades. That's a mismatch. A little bit of good news and then finish. I hope that's okay, Alistair. Oh, I'm over by 2 minutes, I'm sorry. Okay. All right, reality check. Something like $32 trillion of pension assets are lined up behind a UN set of principles to look at long-term issues. So there's 1,200 institutions, $32 trillion, who backed Kofi Annan's vision about long-term risk. Reality check is, this morning in the FT, Jamie Dimon, CEO and chairman of JP Morgan, kept his spot. It's a big bank that does invest in the old high-intensity carbon economy. Who was his independent director as part of that process? It was Lee Raymond, the former CEO of Exxon. I won't say anything, I'm not criticizing anybody, but in terms of a financial system and a real economy system which is misaligned, we have many challenges. Sorry for going over to my other panelists. I'll leave it there. I hope I made some form of sense. The Blended Capital Group is not a whiskey investment firm, although we do drink whiskey, and I'll leave it at that.
Yeah.
Thank you, Paul. So on to Walter Stahel from the Geneva Association.
Does this one work? Yes, okay. Okay, 3 minutes on the role of the insurance sector. Conclusions from a series of case studies which we researched for the GAR report and UNISDR. Insurance basically can help before disaster strikes and after disaster, post-disaster management. Before disaster strikes, it's important to realize insurance contracts have to be closed before disaster strikes. And of course, you have to pay a premium. Insurance has relevant expertise in risk reduction. It has a deep fund of knowledge in risk engineering, risk transfer, capacity to develop innovative products that encourage better loss prevention, which we can sell or use or offer in addition to insurance contracts. And insurance can develop innovative new products. One initiative, for example, allows poor farmers to pay for crop insurance with their work on disaster reduction projects, so not with money. And insurance is also a major investor. It could direct its investments towards infrastructure, buildings, public buildings, whatever, if they meet the criteria for investment. And insurance can be more efficient if it works hand in hand in private-public corporations. But then knowledge building about insurance is essential. Insurance is based on risk-based premiums. Actuarially sound pricing is an essential mechanism because it also is an incentive to mitigate risks. And governments and insurance can promote risk awareness together. Again, cost is a strong signal in all parts of the economy. If the insurance premiums are wrong, this signal doesn't go through. And finally, in post-disaster management, insurance has relevant expertise in claims compensation so that liquidity is effectively and rapidly injected into catastrophe-affected economies. The financial reserves and effective management practices of the insurance industry enable it to deliver fast post-catastrophe compensation, providing much-needed injections of liquidity that contribute to economic recovery locally and nationally. And the same applies also to national infrastructure. Private insurance of public infrastructure helps to rebuild destroyed infrastructure rapidly after a disaster. And finally, we can learn from disasters. After a catastrophe, we can decide whether we want to rebuild or we can make some space for disaster, relocate to safer locations, or if we rebuild, we can do so in a risk-resilient and energy-efficient way by using different construction methods. Thank you very much.
Thank you, Walter. So on to Oz Turk of PricewaterhouseCoopers on current and future business practice and public-private partnerships.
Thank you, Alistair. The public and private sector have a symbiotic relationship in reducing disaster risk. And I think Mr. Mascri, the man in the middle here, realized that there are also many actors involved in actually reducing disaster risk, which is why you have a bit of a dream team here. And the private sector has to play a role, and they are no exception to helping societies and economies reduce the risk exposure. To that extent, PwC worked jointly with the UNISDR, with 15 global organisations, which includes us, PwC, who had a local presence across the globe, large organisations with over $1 trillion in revenue and over several million employees. These included the likes of Nestle, Hitachi, the Citigroup, Walmart, Roche, and many others. There was a cross-section of industries, products, services, and we went into this initiative with, I would say, a framework of trust, where we created an environment where these organisations were willing to share. We looked at human, environmental, financial, operational, and reputational factors. We looked at enablers in these organisations, such as their organisation structure, their people, their supply chains, the technology, and the business strategy they actually employed to reduce risk within their organisations. We also created a very unique framework to engage them. Why do we do this? Because we need a common language. We need to understand their perception of risk, and we need to understand where the improvement opportunities are. And we found some interesting insights as we engage these organisations. All of them, this is a major priority at their board level. They've created amazing cultures within their organisations to actually alleviate the risk, to make themselves resilient, to train their staff, to take a holistic approach to disaster risk management and other risks within their organisation. Great examples of technology and innovation and giving them visibility across their business and supply chain, their people, their partners, and creating resilience within their extended relationships, their supply chain, their security, and resilience within those relationships. There's definitely a desire to share these best practices, but at the same time, the public and private partnerships play a critical role. There needs to be a common language, rather than just an awareness, a more holistic approach to creating resilient economies and societies. There shouldn't be an over-reliance that governments are going to step in and fix everything, especially when 80% and above of future investments are being made by the private sector. A lot of the relationships and a lot of the great case studies you see are still point to point. They're not shared within communities, so that's the next challenge. So to conclude, we need to create a common vision. We need to have a common understanding of what shared value is. There needs to be tangible actions, and we need to understand the external risk, not just within our four walls of say, an organisation, but outside. And to that extent, I would say, I think we've set a great foundation for HFA2. The next challenge is that we've created the momentum now, and we need to take some of these great initiatives, whether they're tools, techniques, training people or organisations, even educating governments, member states, and public institutions on how we can work together to build resilience. Thank you.
Thanks, Oz. And now we'll hear from Richard Olson of the Florida International University, who's going to tell us about some perspectives from businesses in the Americas.
Okay, thank you very much. And I was told that if I stopped to breathe, my time would be up. So let me do an introduction and say we had some research from the US in the early 2000s that showed that 40% of companies that had been shut down by disaster for 3 days failed eventually within 36 months. 35% of small to medium businesses at that time in the early 2000s had business continuity plans, which means, 65% did not. And 80% of U.S. employment was accounted for by small and medium businesses. Andrew mentioned the study we did really in 2012 for this version of the GAR. And we had responses from 1,200 businesses in 6 cities of the Western Hemisphere, from Canada to Chile. And here are the key findings. 19% reported having business continuity plans. The range was from 36% to 1%. Small businesses, businesses with fewer than 100 employees, 14% had business continuity plans. It's not exactly the glass half full, because that means that 86% did not have business continuity plans. Medium businesses, 100 to 499 employees, 34% had business continuity plans, 66% did not. These are high-risk cities. This is disturbing. Large businesses, 500 or more employees, 37% with business continuity plans, 63% without. So why? Well, if there was a consensus answer, there were no positive incentives to do business continuity plans, and there were no penalties if you didn't do them. So we have to change the dynamic. So what are the implications of our particular findings? Rapid urbanization, tremendous commercial expansion, that means exposure's up. Vulnerability's up. Think about the number of firms without business continuity plans. Risk is up, and that means employment is at risk. That's a new part, a more explicit part of a new risk landscape on the planet. And one final thing, since I'm a political scientist, we know that employment in certain sectors increases in reconstruction. But those are not the same people who had just been disemployed by the disaster. And I look at this from a social stability, political stability point of view. Risk is going to have different dimensions, and it has different acuities. Thank you.
Thank you, Richard. So on now to my left to Joe Schuer on the relevance for small and medium enterprises.
Thank you very much. Before I say anything else, let me congratulate Andrew, his team, and ISDR and everybody involved in the report for really producing an outstanding piece of work. We have done some work, a small contribution to this report, to look at micro, small, and medium enterprises and how they're affected by disasters, so in particular the recovery period. And for definition purposes, we looked at businesses of less than 200 people. And basically, three very short messages. One, and perhaps the not so surprising one, is they are typically harder hit than the bigger kind of businesses. They have usually less information, less access to risk reduction measures, less coping strategies, and therefore less ability to basically recover. What was a bit more of a surprise is really what we found in terms of their role in the recovery process. And here it is really very much twofold. One, they are largely ignored by recovery programs. They get very little assistance. They are not part of the planning, and it's very difficult for them to actually start up again their operations. Of course, the picture in a recovery period looks sometimes different. The construction sector obviously would experience some kind of a boom, but overall, in terms of bringing back a certain community and social fabric that was there before, this is a very big issue. And then, to some degree, we already knew that as well, but then actually thirdly, and the third very short message really is that we have also largely ignored the role these businesses can play in the recovery program itself as a driver to accelerate recovery, to accelerate the rebuilding of a community, to provide livelihood opportunities, to restore jobs, and so forth. And we really have to do a much better job to actually address this interplay between private sector and government in terms of both preparing for the recovery phases by equipping this business with the information and coping strategies, contingency plans that they need, by perhaps coming up with some financing instruments that in a recovery phase allow these smaller business to access financing. Because right now we of course do know that recovery programs usually are underfunded. They're often very infrastructure or housing heavy, and there is very little money to go around to actually invest in these small businesses to become operational again. Those are the three short messages. Thank you.
Wonderful. Admirable brevity. So on to Suzanne Becken of Lincoln University in New Zealand on the example of the tourism sector and implications for small island developing states.
Thank you, and good afternoon, everyone. Well, we were tasked with evaluating the business case for disaster risk reduction of tourism in small island development states. And so why SIDS? Well, some of you have been in yesterday's session. And of course, small island states are very exposed to natural hazards. And we heard it yesterday, the clock is ticking. Why tourism? Well, think of any island you know. Most of them depend on tourism, and tourism is concentrated in the coastal zone. So what we did was evaluate the international literature on risk and tourism. And then we went into 3 regions, the Caribbean, the South Pacific, and the Maldives. And we undertook 80 interviews with stakeholders from both tourism and DRR. So what we found was a number of interesting things. One, about the vulnerability drivers. One that is really sort of almost obvious but standing out in all regions is the continuous demand for coastal products. And that means that tourism development keeps pushing into more and more hazard-prone zones. And in fact, the closer to the beach, the better. And we, of course, all know overwater bungalows. And that is exacerbated by the second vulnerability driver, which is still deficient planning systems for coastal management, and maybe they are not there or legislation is there, but it's often not implemented. So that really exacerbates the vulnerability. What we did find in terms of DRR measures that tourism businesses put in place, well, every business is doing it to some degree, so that's good news. They look after the built assets, tourist safety, for example, in the Maldives, you've got life jackets in tourist rooms. They look after the beaches and so on. But what we found is that what tourism businesses focus on is the extensive risks. So it's the risks they are familiar with. They come seasonally, cyclones and so on, they know what to do. What they don't seem to focus on is the intensive risks, the 1 in 100 events that basically are too hard to deal with. So that's a worry, because if they happen, of course, and you think of the broader economy of an island, that's very disastrous. The other point I want to mention, and following up here on the small and medium enterprises, tourism is probably the classic sector that consists of small businesses. And that's why we found that the initiatives that are most substantive are the public-private sector partnerships, because the tourism businesses can't do it on their own. So there's an example, for example, from Samoa, where the Hotel Association works with the government on developing standards for hotels that not only include quality and sustainability, but also include disaster preparedness. So that's quite a good model, and we recommend something like a global scheme along those lines. Now, just to finalize the business case, what we found in our research is that there's a very clear business case, and I don't need to make the argument here because all of you know it. The tourism businesses know it too, but are they doing it? How much do they invest in DRR? Not so much. And the key barrier is perceived cost. Okay, it's the long-term versus short-term business imperative. The second problem is that tourism businesses don't know the costs and benefits, so they don't have any quantitative data for tourism-specific cases that give them a return on investment. So in the end, they basically don't invest. So what we recommend is provide more of those quantitative data, and then disseminate, provide training, provide tools that make it as easy and possible for those small businesses in the island states. So I had to be very quick, but if you are interested in tourism, we've got a whole report on that. See me afterwards, and I can email it to you. Thank you.
Thank you, Suzanne. Next, on to Yohara Belali from Save the Children on the findings for drought risk and resilience in Africa.
Thank you very much. I would like to thank UNSDR, firstly, to engage with the humanitarian system, the academics, and the private sector in Africa to present these findings in the GAR. So, ladies and gentlemen, good afternoon. We heard that drought is a very complex and probably the most complex disaster, especially when it is coupled with food crisis. And this is what I'm going to focus on. We ask and are asked to tackle the underlying causes. But are we really ready to follow the implications of that statement? One of the complexity of drought is that the underlying causes and the impact are completely intermeshed and exacerbate each other in a downward spiral. So obviously, it is an issue of chronic vulnerability of social, economic, and environmental systems. It is not about rain. Another misconception is that food security is an issue of food availability. It is not so. It is one of food accessibility. Dealing with food crisis by intensifying the production is as unsustainable as thinking that the humanitarian system will resolve the problem. So let me explain why. One of the key underlying causes and issues, drivers, are food prices. The first issue is that households are incredibly dependent on food purchase. Save the Children's tool called the Household Economic Analysis showed that in the drylands of northeast Kenya, a household is dependent on 96% on purchase, which makes them incredibly vulnerable to prices. But funnily enough, in the agricultural commodities, the demand and supply balance is not what creates the price. The price is created by other factors. Some of these other factors are speculation and speculative trading. It is a $173 billion business since 2004. Because of the high dependency rates, because of the high import rates from most of the African countries, it happens at the regional level, at the national level, but also at the local level. To illustrate the point that food access is much more important, in 2005, the Niger crisis, malnutrition rates were the highest in places with abundant production. Again, 5 years later, we had severe acute malnutrition, 320,000 children under 5. 1 year later, bumper harvest, the number just decreased of 13,000 children. The third issue is one of agribusiness externalities. This is what we also call the transfer of risks. KPMG states that the social and environmental externalities of agriculture and agribusiness outweigh the earnings of the sector. One example is land grabs. 13 of the top 20 countries for international investment in agriculture are in Africa. Most are highly food insecure. More so, biofuels, as you know, are increasing 700% over the next 20 years. So finally, why shouldn't intensification be the main focus? A third of our food productivity for humans is actually wasted, FAO figures. 37% of animal feed are wasted. It is not a question of food availability. So what is the alternative? Chapter 10 suggests a stimulus package led by governments in partnership with agribusinesses and smallholders and other partners. Such a stimulus package should be within a policy, an enabling environment, and should entail different things: agroecological approaches, decentralized natural resource management, and land rights. Investment in infrastructures, roads, energy, telecommunications, development of markets, social protection, and insurances. A package, an integrated package that would tackle the underlying causes. Finally, these activities should be forward-looking and include also the future drivers of risk. Thank you very much.
Thank you, Johara. Our penultimate speaker is Randolph Kent of the Humanitarian Futures Programme, and he'll be speaking on the policymakers' perspectives of future risk.
Thank you very much, Chair. I'm assuming this microphone is working. Yep, fine. Thank you very much. I'd like to approach what I think is the GAR's really outstanding product this time round from a slightly different angle. I'd like to begin by talking about governments. And my first point is that I am very surprised, based on our own research, at the very limited perspective that governments take about the kind of longer-term disaster risks that we might face. And in a sense, going through government plans, strategies, etc., what I think one sees all too often is a deep and fundamental failure to recognize what you might call the interrelationship between natural hazards and technology. And I think this, whether you call it cybernetic failure, or whether you call it radioactive tailings, or whether you call it, dare I say, even pandemics, which also is part of a technological natural hazard fix, governments on the whole have really failed to come to grips with a whole new dimension of longer-term crisis futures. That said, one of the things that we did is to try and say, let's understand how governments actually perceive this. And so we did a preliminary survey, which we hope to build upon, in which we asked policy planners, how do they see longer-term risks? What are they doing about it? And where do they get their information? I think you'll find that the conclusions are depressingly obvious. Longer-term strategies normally are based upon what you might call budget cycles. So preparation for a longer-term risk just is not there. I think what you also see, however, is a tinkling, a small trend where government policy planners are beginning to recognize this, but feel that there's no incentive to do anything about it. Quite obviously, and anyone who's worked in any large institution will recognize this, the stovepiping, the inability to get information from one ministry or department within a ministry across that might indicate the sorts of crisis drivers that one has to consider is just extraordinary. This happens not only across ministries. It is fascinating, and I say this in the British context, when you take a look at some recent works about how to engage science in the longer-term planning, the failure to bring in social science with the natural sciences. And that gap, that stovepipe, is also clearly evident. There are very few effective platforms that government uses to bring, for example, the private sector and others, including the humanitarian sector, to discuss with ministries. I'm also amazed at the isolated perspective that governments take. For example, the fact that the action of one country might impact upon my country is rarely ever taken in terms of an analysis, ever taken in terms of longer-term risk. So with that, I think that basically, and this takes me to, if you like, the private sector, I think the private sector has an extraordinary obligation in of itself to show the value addeds and comparative advantages to government. If government doesn't take the initiative, then I think private sector has to, because ultimately it's about the private sector's own sustainability. That is not being done. I'd like to just, my penultimate point is to conclude on something which I think my humanitarian colleagues will find deeply, if you like, concerning. I think we have to look at a new kind of relationship, and that is where the military and the private sector engage to deal with vulnerability. If you take a look more and more in certain countries' doctrine, there's something called phase zero, which is pre-prevention. It is to ensure that there is stability even before one has to identify things to prevent. This is where the public and the private sector really do come together. it is the military in its attempt to get phase 0 in place that will need to work more closely with the private sector who's looking for sustainability and resilience. So if I may just say, on that particularly contentious note, let me end with one final point. And that is, I mentioned the need for the private sector to take and to engage with public authorities to really generate the sort of longer-term thinking, innovation, and innovative practices that governments all too often lack. In Great Britain, there was something called the Humanitarian Emergency Response Review, the HER, that tried to promote that. And what was fascinating and continues to be fascinating is how extraordinarily difficult it is to get the private sector to see this natural linkage and to get governments to try and reach out to make that linkage. Thank you.
Excellent. Thank you, Randolph. Our final speaker is Omar Dario Cardona of CIMNE Consortium, who'll speak on the relevance of the new global risk model and its key findings. And after him, it's over to you.
Thank you, Mr. Chairman. Well, the aim of the global risk model for the GAR 2013, of which the technical basis and results have been included in the prevention web, is to obtain disaster risk figures for all countries of the world, taking into account the major hazards that result in catastrophe risk. The assessment of both hazards and risk that was carried out for GAR 2013 is based on a probabilistic analysis, which results in risk metrics such as the average annual loss or the pure risk premium, and the probable maximum loss for different return periods. These metrics are considered for most appropriate form of measuring disaster risks in any scale. On one hand, the aim of this study was to produce a risk assessment at global level, which requires a series of simplifications and assumptions, coherent with the scale of the analysis. And on the other hand, this report wants to underline the necessity for countries to undertake risk assessment with better resolution and details at national and subnational level, using consistent information appropriated with the scale of analysis, but with the same probabilistic approach and method presented here. In other words, it is possible to use the same arithmetic as subnational and local level. In fact, this approach can be considered to be the correct for the catastrophe risk assessment caused by one more conjoined or cascade hazards. It's important to say that the analysis of risks at global level until now has been carried out based on historical events recorded in international databases. For example, the analysis is carried out for the GAR 2011. This new global risk model, until now the only one of the kind, takes into account events that haven't yet occurred by using a probabilistic predictive method that calculates losses due to possible future events. The calculation is carried out considering the uncertainties related to the hazards, the exposure, and vulnerability. This is the first study that measures the risks in probabilistic terms for all the countries in the world using the same arithmetic or measuring ruler. In some aspects, the analysis is similar to the one used by insurance and reinsurance industry. The main difference, however, is that the evaluation analysis carried out for insurance and reinsurance purposes mainly cover limited insured portfolios. On the other hand, in the case of this study, the risk has been calculated by using a proxy of the total value of the assets of the country, as well as of the fiscal responsibility of the governments. Such fiscal responsibility was calculated considering both the public assets and those of the low-income private homeowners, as they will require the government's intervention for the rehabilitation and reconstruction. The assessment of future losses on these portfolios allows quantifying the sovereign risk from disasters. This type of risk has to be taken into account by the Ministries of Finance, Economy, or Planning, with the aim of reducing the fiscal vulnerability of the countries. This risk assessment carried out in this study has been done with an open model that can be used by every government or user, the CAPRA platform. That is, comprehensive approach to probabilistic risk assessment. This platform is open access, open source, and has a modular architecture and can be used free of cost. The development of this platform has been made with the financial support of the World Bank, the Inter-American Development Bank, and the UN ISDR. The CAPRA model has been developed by our team that made this work for GAR 2013. Finally, this is important to say that a risk assessment at global level can only have a coarse-grained definition. This means that it has to be done consistently in each phase of the analysis without excessive detail or precision. A high level of precision will be, in fact, irrelevant for the scale of the analysis. It will not be possible to produce a high-resolution global risk assessment due to the lack of detailed information for all the countries and because the time and money that it will require. A global level analysis allows obtaining results that provide an idea of the magnitude of the disaster risk at the national scale. It also allows producing general classifications and rankings between the countries based on their risk using relative indicators. These indicators are particularly useful to identify disaster risks at global level and for comparative purpose, in order to highlight the need of carrying out measures for risk reduction, finance protection, and disaster preparedness. Also, of encouraging countries to undertake risk assessment with improved detail at subnational and urban level, using the same probabilistic approach. Thank you for your kind attention.
Thank you, Omar. Well, we have inevitably overrun our time, but we do have some time, I think, to pass across to you. If you have any questions you want to ask, there was an awful lot there to chew over. There's a gentleman at the back in the blue shirt. Just shout.
Okay, so it's Marcus Oxley from the Global Network of Civil Society Organisations for Disaster Reduction. It's quite a daunting panel in front of me, but here's a few thoughts on this. First of all, well done to the GAR team for taking on this this important challenge. You know, there's a compelling logic when you say that 85% of financial flows come through the private sector, and conclude that unless we engage the private sector, we're not going to really, you know, be able to reduce disaster risk. I'm totally on board with that. When I was looking at the World Economic Forum, I want to draw out some implications for the post-HFA now, the HFA2, which is one of the key negotiations.
Could I encourage you to come to a question?
Yeah,
Thanks.
I'll go quickly. When I look at the World Economic Forum and look at their risk map, they plot out 47 risks which impact on large corporate enterprises. And they say that the risks are interconnected and it's complex and it's fast changing, and you can't predict when one specific risk is going to manifest itself. So the approach that they recommend is a much more building systemic resilience to shocks and stresses of all kinds. Now that's interesting because when you go to the community level, where also they face a multitude of different risks in a complex, unpredictable environment, the community do not invest in standalone natural disaster risk reduction actions unless it's project-house funding. In other words, they take a much more holistic, a much more comprehensive approach to managing risk. So the implication of that is, shouldn't we be drawing public policies from good practice, looking at what the micro level is doing, looking at what the macro level is doing, and advocating for an HFA2 which is premised on a much more broader interpretation of risk that is about systemic resilience to do with...
Thank you. Okay. I think we've caught the gist of the question there. I think, Andrew, that's probably one for you.
Yeah, let's take a number of questions.
Yeah, okay. Let's pile up the questions and we can address them all at once. Are there any more questions? Okay, Andrew, looks like you've got a short list.
I mean, the answer is very simple, Marcus. I think the answer is yes.
I am going to ask a very brief question of my own. Do we have a sense of the size and the pace of change in the value of economic assets that are at risk from natural disasters?
Ask Omar.
Yeah, Omar, is that one you would like to take?
Indeed, we have the information country by country.
Country by country.
We are not making the sum of all values in the exposure.
Right. It's presumably a quantity that's growing.
We have been using evaluating the stock of capital of the countries, but particularly the produced capital of the countries in order to have a proxy of the values at risk.
Okay, if there are no more questions, shortly we're going to be addressed by Professor Shinichi Takemura, who's going to take us on a very brief tour of the globe, specifically that globe over there at the end of the table. But before we do that, I'd like to thank the panel, all the presenters, for heroic attempts at brevity. And I'd like you to join me, please, in saying thank you. And briefly, Professor Takemura.
Thank you. Microphone. Oh, yes. Okay, yes. As a communication consultancy for UNISDR, we have been engaged in the concept design and the visual design of the GAR-13, including this inverted A logo and the inverted umbrella symbol mark. And I'm sure the distinguished participant here all read through the 288 pages of the GAR-13, but outside this conference center, how do you communicate and disseminate the important message of the GAR-13? To call attention to the disaster risk among their local community members and to raise awareness of the importance of DRM among their corporate members or their stakeholders, especially shareholders. You need some effective simple, effective, strong communication tool. That is why we proposed and created the tablet version GAR. Actually, I'm sure many of you have tried to download the application. It's downloadable already. Oh. It's gone. Yeah, we need to download it, yeah. Yeah. Well, actually, here's the GAR symbol, and if you touch, oh, sorry. If you touch the GAR symbol, here's the digest version of the GAR. Actually, the texts are from the GAR at a glance, and some of the key messages are shown with the some dynamic representation of the disaster hazards event, or this case the disinventar, and also as somebody mentioned, the natural capital are endangered. It's shown with the wildfire. The loss is estimated as $3 trillion per year. So if you put the GAR at a glance on the wall of your bedroom or something, you can't carry this. But whenever you have the iPad like this, you can show the essential part of the GAR, and also the one of the most essential messages that this is we humans who increase the risk, disaster risk, and disaster risk is the function of the hazard and exposure and vulnerability, and we have increased the exposure and vulnerability in the very flood-prone areas, and so it is dramatically represented in this way, the rapid urbanization, especially at the low elevation coastal zone. Actually, I made a full presentation using this globe yesterday, and if you're interested in, please check the prevention web. There is the link to the video of my presentation. But actually, the basic function and the content of the globe and also the GAR 13 is contained here. And so this is the GAR at a glance on your hand, on your tablet. And also it is the interactive digital globe. You can spin or zoom, or if there is the cyclone being born, unfortunately there is no cyclone now. If there is, it will be shown with the predicted trace. So you can see which area would be afflicted by the cyclone in the next 3 or 4 days. And also the risk maps are shown here, and you can show your peers and community members the detailed risk maps. Or it's a hazard browser, so here's a time bar, and you can choose some hazardous events and browse these major hazards. And also we have the AR function to bridge between the printed analog media and the digital media. So would you please hold? Okay, here's the printed GAR, and with the diagrams, the American drought. So if you touch the AR mark and use this as a window, so you'll get the dynamic animated image of the droughts. Oh, again. It's not a matter of the GAR itself, it's a matter of connection, so. So anyway, yeah, here it goes. Yeah, just like the Harry Potter's newspaper, yeah. Or or finally, I would like to introduce there's another type of the tags. Maybe it's a yeah. Anyway, here's a disinventar. もうちょっと開かないと。And you'll get the interview video of the researchers. So I wanted to visualize who is doing this kind of research and what kind of motivation are there at the background of these messages. So it is very important to visualize how these research are delivered to you. And so it is a way to call for the participation among the local citizens and the stakeholders. So I hope you enjoy this digital version, tablet version, GAR, and take full advantage of this unique tool to communicate to your peers and to communicate with your planet. Thank you very much.
Thank you, Professor. Thank all of you for your attention, and please enjoy the rest of the day.